Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Going through the comment section, going to answer this comment here. It says, can you please expand on why rising interest rates won't impact housing prices? Even if there's incredible demand, if they are unaffordable, how will prices go up? I think this is one major difference between now and the 1970s housing bull market. Unless you're predicting major wage hikes, thanks for all the value you provide. So I think that's a good question. There's a couple of things I think that are going on. So in the beginning of basically when you're crossing over from recovery phase to an expansion phase of real estate, which we're doing right now, this is when houses in history are the least affordable to buy because you have to price out the majority of people in the market because you have housing shortages. That's why inventories are so low. That's why days in the market are super fast. And also keep in mind that there's seasonality in the data. It's seasonal. So we are going to see prices soften for the winter, and then they're going to firm up again in the spring. So this cycles over and over and over and over. And people who are calling tops in the housing market are probably going to be wrong. That we're not going to have a top until you have inventory get replaced. Now, during this time frame, we are going to have inflation. Inflation, which we have today, it will come from new homes being built. Now, what is happening is that everyone is competing for existing homes. And what happens is the price of existing homes gets bid up to the price of the new houses. So they get closer and closer in price until consumers or customers, however you want to call it, prefer new homes. So when they prefer new homes, they go out and they buy new homes. And then the entire inventory of homes in America, because this I'm mainly talking about America, is going to grow as they build more new homes over the average. So that inventory, the total inventory, is going to grow. Now, in an inflationary period, there are multiple things that are happening. Wages are going up. And if you notice, we are, quote, in a supply shortage of everything. And that's really just too much money sloshing around. And then when you have far more money sloshing around in the system, of course, you're going to hit shortages. That's basically what drives prices higher. So you've got all these prices going higher of everything. And you have inflation. Inflation is also going to impact commodities, and it's also going to impact the price of new homes. So what's going to happen is the price of new homes is going to continue to ratchet higher. It's going to drag the entire existing residential real estate market higher with it. So all these things are going higher along with interest rates going higher. And rent prices are going to go higher. All of these things are going to become less affordable, not more affordable, less. There's going to be more and more people getting priced out of the market. And prices are going to continue to go higher because there's no way to replace what you're missing with cheaper solutions. The way that you have prices go down is you're going to have to replace or have new homes be built at cheaper prices. But the price of new homes is continually going up, which is going to drag the existing inventory up. And if you have if you have less homes to sell in relationship to how many buyers there are, you're going to have to continue to price out people. Now, what's going to happen is when rent prices continue to go higher, people are going to look at this and they're going to say, I don't want to pay 15 or 20% more higher rent prices because everyone now is competing for rent if they can't purchase a house. If homes become less affordable and they can't buy, then everybody becomes renters. Now everyone's competing to rent and rent prices go through the roof. So, and that's what we've seen. Rent prices here have gone up 15% over the past year and a half. And there are people, our neighbor here, there's a house that is owned that rents it out. They said our rent price was going up $500 a month. And they said, we're just going to buy a house. So they went and bought a house. I mean, that is literally exactly what I'm talking about. They had to make a decision. Do I rent or do I buy? And if your rent prices are going through the roof, they'd rather buy a 30-year fixed rate loan and buy a house and lock in their costs than to rent again. And that's what a lot of people are choosing to do. A lot of people also are getting priced out of the market and are now becoming renters. That's what the new person is. That went in there. They said, you know what? We were going $50,000 over asking. We didn't buy it. We didn't get any of the 7 homes that we bid on. So we're going to rent for a little while and hopefully the market calms down. I don't think it will calm down. I think the prices will continue to go higher. That's what all the projections are, and we have no inventory here. So I would suspect prices to go up probably between 10 and 20% next year, at least where I live. I don't know about other areas, but we have a lot of buyers and there's not much inventory here. So I would suspect a strong price increase for next year. The 70s was in the same situation as we're in today. It's the same thing, especially in the late 70s. Late 70s had a massive increase in interest rates. And that was a demographic coming through, and we basically went into a housing shortage. All the new homes were getting bid higher and higher. Sorry, not bid, but new homes had the inflation impacted where it cost more and more to build the homes. In some areas, housing markets went up 10x or more, 10 times. I have a feeling that we are going to have a similar situation to that. I don't know about 10x, but it's going to go up a lot because of the housing shortage, the deficit. You'll never have a deficit. The prices will just continue to go up. And more people will have to be priced out until you hit an equilibrium. That equilibrium price, I can't tell you exactly where it is, but I can tell you it's higher than what it was 5 years ago, way higher. And we're not going back down there, in my opinion. I think we're still cheap. I don't think we're going to see prices even a year ago. Well, we won't go back down there. And there was data that I was listening to over the past 80 years. 80 years, house prices have went down like eight of those years, and 4 or 5 of those years were all like back to back from the crash that just happened. So there was like 2 years, I think it was 2 years. If you take out that crash, there was 2 years where home prices went down. And you know how much they went down? It was something like 1% and 0.8% in those 2 years. They barely ever go down. So a lot of these people that are calling for a major crash in housing, I don't think they're going to get it. There's the history, number one, the history doesn't bear that, except for one market crash. And that one market crash was a bunch of bad loans that were given out to everyone. So all those bad loans foreclosed, and a whole wave of homes came online for like 3, 4, 5 years. And it was a lot of homes. It dwarfs whatever's in the forbearance, absolutely dwarfs it. It's like 3 or 4 times as big. And I don't think these forbearance homes are going to come on the market like you guys think. They're not going to come on as foreclosures. They're just going to be sold. Everything has positive equity. Back then, everything was underwater. It's totally different market conditions. And the inventory back then was 10 months. We have like less than 3 months in total active inventory. And so I don't see, I mean, yes, it can soften from seasonality, but I don't see where the homes are going to come from to really blow up our inventory. That's my take on it. And yes, things will slow down at some point because we're at the max increase in home prices is like right now. This is the least risk time to own a house and have it appreciate. It's like the 5 years around the recovery to expansion phase timeframe. This is where you get the most gains and the least risk. And everyone here is so worried about home prices going up. I don't know. That's kind of my take on it. So that's real estate. That's my. It says unless you are predicting, and I do predict that we're going to get wage hikes. Definitely, we already are getting it. We are pricing at my work. We are pricing the lower earners all far higher, like multiple dollars per hour higher. And we're also the people that I know are swapping jobs because there's so many jobs out there. I'm going to do the same thing, and we're all getting like 30%, 20% more in pay. So yeah, we're getting paid a lot more. And another thing to think about is when interest rates go up, money's going to rotate out of bonds and stocks into probably real estate and precious metals and commodities, because that's a lot of money that's got to rotate somewhere. And a lot of people aren't, it doesn't matter about wage hikes. It matters about these people. They're going to be renters, because the major money that's going to rotate and buy real estate, it's got to go somewhere. I mean, I'm even thinking about buying another place and doing it before all the major hikes come. I think people are just going to be priced out of the markets indefinitely. You're either in or you're out. And things are going to become a lot less affordable, especially if energy prices increase dramatically, because then it's going to increase the new home price builds dramatically higher as well, if all your input costs go up and your labor goes up. So I would take that into account. That's just me. So I'll end it there. Put in the comment section if you guys have any other questions. Thanks for asking the question, and subscribe to the channel if you haven't already. Thanks for listening. This is Finding Value.